Welcome back to my Vanguard Portfolio update now for November. We've missed a month, unfortunately, so let's have a little dive in. Quick recap going back to September's update, if you remember that one. We've got two accounts, the ISA and the SIPP. The ISA was sat at £11,641, and the SIPP, which is my pension, was sat at £42,994 now. Of course, as you know, we've already seen the worst start to the stock market in the last 50 years. Frankly, over the last couple of months, things have been a little bit better. We did see the bottom of the market, at least on a year-to-date perspective, back on the 12th of October. So where we end up over the next couple of months, who knows? Now, typically, the last couple of months of the year, and at least going into the early start of next year, do tend over the very long period to be actually a decent time to invest in terms of growing and accumulating most of the gains from the year. Whether that's going to be the case in 2022, who knows? One thing you might have noticed, especially if you're in individual stocks at the moment, is things have been incredibly volatile. Big swings any day of 5 or 10%. Of course, even companies like Snap in that social media space dropping 20, 30% in a single day. Things are crazy at the moment. And of course, when there's a massive green day, everyone thinks all of a sudden that things are going to change. And then all of a sudden, if there's another red day, people think that's it, the end of the world. So you've got to hold on to your hair at the moment because things are pretty crazy. Now, quickly, just before we go into the portfolio, just a kind of quick view of what's going on in the markets at the moment from the US perspective and here at home in the UK. In the US, kind of investors and traders seem to be obsessed at the moment with trying to predict what the Fed's going to do. So the US central bank trying to work out especially what they're going to do with interest rates, and all over lots of news at the moment and different articles, people are always talking about the Fed pivot. Now, of course, people are trying to guess at what point that the Fed stops raising interest rates, because of course high interest rates are very, very bad for the stock market in general and for the wider economy, because of course it's much harder to borrow money on the cheap. It encourages saving, it pushes the cost up of government borrowing, and it also pushes the cost up of things like mortgages too, so people looking to get on the housing ladder. So of course the higher that goes, the weaker that looks for stocks, because the actual gap between the returns you can make in the bond market compared to what you can make in the stock market. And that's especially true in the case of those young growth stocks who need lots of money pumped in, lots of cheap money, because their profits are much further out in the future. And if you're ever interested in these things, you can actually get the Fed minute. So if we have a look here on page 4 of the latest FOMC meeting, you can see a poll of what the members are actually guessing. So the little dots here are all the individual members of the FOMC guessing where they think interest rates are going to land. So as we can see here, next year, 2023, seems to be where they think it will potentially peak. And then slowly year after year there, they think it's going to get turned around, of course, the pivot happening, and then things will go back to what we want to call normal. Now, unfortunately, our normal has been very much used to very low interest rates, basically free money for not only consumers, but businesses. So what the new normal turns out to be, who knows? But it's very interesting at least to look at what guesses they're making. Now, from a UK perspective, I think this will be the first time I'll ever get to say this, but between my portfolio updates, we've had two different prime ministers. Of course, Rishi Sunak's now in place. Liz Truss has been given the boot after that crazy stuff going on back in the markets. Some things have seemed to somewhat stabilise. We're still down around 17% against the dollar when we look at the pound, but of course that has been going on for a little bit longer. We are heading into winter, of course, with concerns around energy prices, lots going on from that perspective. And then the mortgage rate and the mortgage markets still going to be seen relatively high. The bond market has come down somewhat. As you can see here, I'll put this on screen now. This is the 30-year gilt. So, of course, the higher the yield, the lower the price, and of course vice versa to that. So as we can see here, the yield has come down slightly from where it was going crazy when people were selling it off as much as possible. Okay, let's first start at the ISA. We can see now the value is at £11,369.18. Not a huge amount of movement, to be honest, but you can see the personal rate of return that Vanguard is calculating for me is 3.62%. Now, as very regular viewers will know, I pretty much have most of my holding in the VUSA, which is an ETF covering the S&P 500. And if we have a look at what investments I've got, I also have that, of course, but I do have a very small holding in emerging markets. Now, emerging markets are the ones here, as you can see on screen, which have been hammered. And of course, over the last couple of days as well, you would have seen even more negative news, negative sentiment come out, especially toward that Chinese market, which of course, I think, pretty sure is the largest constituent of that emerging market space. Certainly the world is a little bit crazy at the moment, very much away from the stability that we'd like. Very much feels like the world is deglobalizing, if anything, at the moment. But of course, who knows what's going to happen on that front. So We have a negative number from there, a positive number from the VUSA, which does actually leave us then with a slight positive return. But in the very, very long term, it doesn't necessarily matter what I'm seeing these numbers here at the moment. If I just jump over to the transactions tab, you can see that I did make a small purchase and got another share of VUSA, and that money purely came from the dividends that I got paid from VUSA itself. Now, just another reminder, I think I might have mentioned this a couple of months before, but when you get paid dividends into your Vanguard account, if you are buying things like VUSA, which pay out dividends and they don't automatically reinvest, that cash just gets put into your account. And frustratingly, Vanguard don't send you any notification or anything like that at all, which is really, really annoying. So please, 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 if someone's watching from Vanguard, please just send us an email when we get a dividend or something like that. I think that's so important. Anyway, that cash then will just sit in your account and do nothing. You do get a small amount of interest on it, but that's another matter entirely. So anyway, just make sure you regularly come in and check your account. VUSA and a lot of the other ETFs will just pay quarterly. So once every 3 months, you're gonna have to go in there, check if you've got enough to buy enough of your other ETF and make sure you've got enough there. And for the S&P 500, of course, as you can see here, it's about £63 at the moment, but of course that will increase as things grow. So just be aware of that one, because that's a conversation I had to have with my girlfriend the other day. She won't be watching this anyway, but when she monthly invests into VUSA and might be a couple of other mutual funds, the issue is that she's probably going to have quite a bit of cash now on the side, which we need to make sure we reinvest in. So do make sure that you check that one yourself. Now, on a slight tangent, the way to get around that would have been either to buy a mutual fund, which of course doesn't pay out a dividend, or if I wasn't actually using Vanguard as a platform, there is a version of VUSA which then just accumulates those and doesn't pay out a dividend and just reinvests it automatically. That ticker symbol, if you're interested, is VUAG. So if you're using another platform like Trading 212, InvestEngine, and pretty much any other major investing platform, that's the one you can search for, and that will actually just invest everything for you automatically. So to be honest, I wish Vanguard offered that on their platform, because I would probably use that one. As a long-term investor, I'm not looking for income from this. I just want to snowball my wealth as much as possible. And don't forget, if you are interested in looking to invest yourself and get started, check out the links in the description below. I always have the latest offers of free shares or free money for yourself to get started. But absolutely, yes, look at VUAG if you are interested, or different ETFs which cover the S&P 500 and accumulate rather than pay out. Okay, so that's pretty much straightforward on the ISA. Nothing much to see there. Thankfully, things haven't gone crazy far down. Are we at the bottom of the market? Who knows? I'm not going to make that call. It certainly feels a little bit more positive, but at the end of the day, we're very many years away from anything happening. Okay, pension, let's have a look now. So £42,083.50. I always feel like a very old man looking at my pension. As you can see at the moment, things are very much all in the red. Similar way, similar setup to my ISA. It's very much just an S&P 500 with a little bit of emerging markets. Mutual fund, of course, both of those are down at the moment. This was a big lump sum that I put in a few months back now. As many of you will know from various pensions that I had, I put everything in one place. This money can't be touched though in a SIPP, remember? Can't be touched until at the moment, current rules, I think are about 58, and that might get moved as we progress anyway. So this money is completely locked in here. I may add to this at any point. Remember, with a SIPP, if you do add money, your own personal money in, you can get a top up from the government, but then on the way out, there are taxes to pay and certain allowances that you get as well. So I can put them up on screen now. Do all of your own research with all of these things, guys. Remember, I'm not going to be your financial advisor, so please do your own research. But personally for me, it was really important to make sure I managed my own pension and keep an eye on things. I quite like that. But for some people, you probably don't want to have a look into this. You want someone else to manage it. So I'll leave that one to you. Now, quickly from a performance standpoint, if you are interested, of course, you do just go to your performance tab. You can actually see the changes month to month. It doesn't necessarily matter from a really long-term perspective what that looks like, but you can make yourself scared if you want and see how bad the stock market was in months like September, for example, of personal investment returns nearly £2,000. But of course, getting ourselves back up there in terms of October. So crazy, crazy, crazy times at the moment. And again, just a note here, if you're going to have a lot of money in VUSA or in an ETF that pays out, again, it's going to pay out a dividend. So keep an eye on that. At the moment, you can see in my account, I've got £31.80, which is fine. Sometimes you can actually use that to help pay the account fees. Personally, I just have mine set up a direct debit every time they want to take those fees, because I want to invest as much as possible. But keep an eye on that, because I bet there's some accounts out there that's probably got quite a lot of cash in their accounts doing nothing. So just a word of warning. Now let's just get the full account value up here for you. So that's £53,452 and 68p. That's both the SIPP and the ISA together. Now, at the moment, of course, if you're started investing or if you've only invested over the last couple of months, you're definitely going to see yourself in the red. Now, you're probably thinking, again, what a terrible time to start investing. I've missed all of this wonderful bull run and now everything's going to go down and it's all the end of the world. Well, tough times like this, personally for me, I think are going to make some very effective investors and very tough ones. I always think about like this: if you were going into the casino and you were going to make your first bet and you happen to have a bit of beginner's luck and see yourself double or triple your money, you're going to feel pretty invincible and feel like you can pick any stocks and investing's really easy. Or in that example, gambling's really easy, when of course that's a mug's game and it's something that's going to lose you a lot of money in the long run. From an investment perspective, I think if you start when the market's really, really good, you're going to get a weird sense that everything's really easy and it only goes up, when in reality, starting now, I think it's going to make people incredibly strong and incredibly resilient. Bear that in mind and kind of think that actually you are getting a bit of advantage here, because when the next crash or correction comes along, which it will, and I'm not even saying this one's even over yet, that you will actually be a better investor because you know what it's like to see your account in the red. And actually, when you see these red numbers, you need to flip the mentality around that says, this is sale time and not, oh crap, I'm losing everything. So I hope that helps anyway. Now, just before we wrap things up on the portfolio update, here's one thing I think is quite interesting and kind of one of the reasons I actually do these portfolio updates. Ultimately to show you, I walk the walk and I talk the talk about what I invest in, but also that we're all in this one together. So I just saw this information pop into my inbox, and this comes from the blog of Dollars and Data from Nick Maggiulli. And I found a little interesting piece here saying that the 60-40 portfolio, which is a very kind of defensive, quite classic portfolio of 60% in stocks and 40% in bonds, has actually had its worst year since 1931. And it currently sits at negative 21% if that was the makeup of your portfolio. Now you can see on screen, a 60-40 portfolio has had a relatively good run over the past few decades, with of course relatively high interest rates at least a few decades ago, which will give you some decent yields on those bonds and decent returns even when the stock market was low. And then having 60% weighting toward the stock market should then, in theory, give you better access to those gains in the market. But unfortunately, it just shows at the moment there's been nowhere to hide. So unless you're doing some really clever things and you're shorting the market, which personally is something I would absolutely never do, and not waste my time with any crazy options calls or try and time the market, we're all in this together. Things are very, very bad at the moment. Where things will go, nobody knows. But ultimately, you've got to stick to whatever plan you've got, whatever that may be. Please find your own way. So again, for me, it's always a reminder that you just got to stick to your own plan, do what you do, find what works for you, and you just got to keep doing it through thick and thin, but especially through thin, because of course, the bargains we're going to get today, if the stock market is near the bottom, we're all going to be comparing and all going to be laughing about in many, many years' time and wishing we'd potentially spent more. Anyway, I hope you've enjoyed that one. Don't forget to drop me a comment, leave me a like below, and subscribe for many more. And as always, thanks for watching and happy investing.